Welcome back to The Explainer. Today, we're tackling an absolute monster in the fixed income section of the CFA Level 1 curriculum, interest rate risk. Look, whether you're cramming for the exam or stepping into real-world portfolio management, understanding exactly how and why bond prices fluctuate is absolutely essential. So let's jump right in. Here's our quick roadmap for today. We're covering core mechanics, measuring risk with duration and convexity, checking out risk by bond type, immunizing portfolio liabilities, dodging common exam pitfalls, and finally, we'll run through some step-by-step practice problems. All right, part 1. Core interest rate risk, the foundational mechanic. Okay, there is a core inverse relationship that you literally must commit to memory. When market rates go up, bond prices go down. It's like a seesaw. Think about it. If you own a bond paying a 5% coupon and suddenly new bonds hit the market offering 8%, well, nobody's going to buy your 5% bond unless you offer it at a serious discount. On the flip side, if market rates drop to 3%, suddenly your 5% bond looks incredibly attractive and investors will happily pay a premium for it. So prices go up. Now, you really got to watch out for the tug of war here between price risk and reinvestment risk, because they pull in completely opposite directions. Price risk is exactly what we just discussed, the danger that rising rates will just crush your bond's market value, and that's especially high for long-term bonds. But wait, on the flip side, we have reinvestment risk. If you hold a high coupon bond and market rates fall, sure, your bond's price goes up, but now you're forced to reinvest those juicy coupon payments at the new lower interest rates. Moving right along to part 2, measuring risk with duration and convexity. So, modified duration. This is your linear baseline. Basically, the higher a bond's duration, the greater its interest rate risk. Look at the formula. It's essentially giving us the approximate percentage change in a bond's price for a given shift in yield. Let's say your modified duration is 6, and rates bump up by 1%. Bam, your bond's price drops by about 6%. It's a simple, elegant tool for quick risk assessment. But does duration tell the whole story? Can we just completely rely on this straight line approximation to predict what happens in the real world? Well, no. Actually, no, we can't. And that's exactly where convexity comes in. Think of convexity as your bond's shock absorber. The crucial point here is that convexity improves our bond price estimates beyond just duration because the price-yield relationship is actually curved, not a straight line. Why do investors care? Because bonds with higher convexity have this amazing trait. They lose less value when rates rise, and they gain more value when rates fall compared to what a simple duration metric would predict. It's a massive advantage. Next up, part 3, risk by bond type. Let's see how this actually plays out across different instruments. Notice how clearly zero-coupon bonds sit right there at the top with the absolute highest risk. Why? Because you get zero cash flow until the very end of the bond's life. You're waiting the maximum amount of time, giving it the highest duration for a given maturity. Now contrast that with the floating rate notes at the bottom. Because they periodically reset their coupons to match the current market, their prices stay super stable, very low interest rate risk. All right, part 4, immunizing portfolio liabilities. How do portfolio managers actually use this stuff in the real world? Through immunization. Imagine an institutional investor who knows they have to pay out massive liabilities in exactly 5 years. By creating a bond portfolio with a matching duration of 5 years, they effectively lock in their ability to meet those obligations. They successfully immunize the portfolio against rate fluctuations, regardless of what the central bank does next. Part 5, common exam pitfalls. Let's talk about where candidates tend to drop easy points. Okay, first trap, don't ever assume a longer maturity is somehow safer. In fact, a longer maturity significantly cranks up your price sensitivity and risk. Second trap, forgetting about zero-coupon bonds. Never forget they represent the absolute maximum duration for any given maturity. And third, keep in mind that yield curve shifts aren't always parallel. Sometimes the curve steepens or flattens, meaning short-term and long-term bonds are going to react totally differently to the exact same economic news. I want you to visually separate these two terms in your mind right now. Duration is absolutely not the same thing as maturity. Mixing them up is a classic rookie mistake. Maturity is literally just a calendar date, the final payment date. Duration is a measure of time, sure, but it is the weighted average timing of all cash flows. Duration is what actually gives us our primary measure of interest rate risk. Finally, part 6, step-by-step practice problems. Let's put this into action. Take a look at this prompt. A bond has a modified duration of 8. Yields rise by 0.50%. Before we do any math, think about that core inverse relationship we just hammered home. If yields are going up, what's happening to the price?
Well, let's break this down sequentially so we don't get overwhelmed. First, because rates went up, we know for sure the price must go down. We can instantly throw out any increase options. Next, we grab our formula. We take our negative duration of 8, multiply it by the 0.50% yield increase, and we've got our answer.
And there it is, a 4% decline. So the correct answer is B. If you nailed that, you're successfully applying the modified duration formula. Great job.
Let's try one more to test your conceptual recall. Look really closely at the maturity lengths and the coupon types here. Which one of these is going to swing the most wildly if central bank policies suddenly change?
If you guessed C, you are absolutely right. Like we established earlier, when you combine a massive 30-year maturity with a zero coupon, you get the highest possible interest rate risk. Your cash is completely locked up until year 30, so your duration is effectively maximized. As you wrap up your review, keep these pro tips in mind. Focus on actually understanding these concepts rather than just rote memorization. Drill those duration calculations until they're second nature. And remember, the CFA exam loves to test how well you can link a basic concept like interest rate risk to broader topics, like shifting monetary policy or pricing complex derivatives. So think about it. How will mastering interest rate risk today unlock everything else for you in level 2? Building this rock-solid foundation now is going to give you a massive edge moving forward. If you can master the math of a simple bond right now, imagine how easily you'll decode the complex derivatives waiting for you tomorrow. Keep at it, and I'll see you in the next explainer.